Hello and welcome to this IBSA podcast on the topic of US exposed persons moving to Europe. My name is Roy Saunders, founder and chairman of the IBSA, the International Business Structuring Association, which is a multidisciplinary global association of entrepreneurs and their professional advisors dedicated to sharing their expertise with each other within a great networking platform. And today I'm joined by Darren Hayden-Joseph, specializing in international cross-border taxation for US individuals. Maybe they're moving to the UK or beneficial regimes such as Spain or Italy, or other fairly high tax jurisdictions such as France and Germany. Darren will also be covering the taxation of trusts in the US and beyond. So there you are. Darren, what are your key points that you'd like to talk about?
Hi, Roy. Pleasure to be here again. My name is Darren Joseph. HEJ.tax, a member of Moore's Rule, and we're a team that seeks to demystify the sometimes confusing rule of international tax.
So now, with Spain, and I know Portugal has changed its rules as opposed to the non-habitual resident, but you've got Spain and Italy with beneficial tax regimes. Mm-hmm. If you've got a US citizen that is going to be subject to US taxation on all of his income anywhere in the world, wherever he is resident, are these beneficial tax regimes useful for US citizens going abroad?
Potentially there would be. I mean, bear in mind that they're all going to be temporary in nature, but at least for that initial period, it is something to consider. France doesn't have any. They have an impatriate regime, but, for the high net worth individual, they're not really on a salary, so that maybe doesn't make a difference. Italy has one as well, and Belgium and some other jurisdiction. So you mentioned in Spain, there's the Beckham Law. More recently, there's like a startup law, which Portugal has mimicked. So what, in fact, happens, Portugal is still in play, but they've kind of shadowed what Spain is doing. So Portugal is saying, just by virtue of showing up, you're not going to get a 10-year break. What you can do, however, if you start a company that's bringing jobs to Portugal, then yeah, this could be interesting. And if you are an employee under that company, then you effectively have a quasi-territorial tax regime. So therefore, your Portugal source income will be taxed. And there's a lot of, somebody said it's a Swiss cheese of regimes. So there are quite a few exceptions maybe, but for the most part, your foreign source income is not going to be taxed and you can bring it in. So whether you leave it outside or bring it in is irrelevant. You can do what you like. We're just going to tax your domestic income for 10 years. Spain says the same thing as well. There's a startup regime. So we prefer if you start a company, but even if you're a digital nomad, a so-called remote worker, come. And for a period of 6 years, we will treat you as tax non-resident, even though from an immigration point of view, you are resident. And we'll only tax you on your Spain source income, which you do outside. We're blind to it. You can bring it in if you want, but it's only for 6 years. So Italy has that flat tax of 100,000, which again is quite competitive compared to Switzerland's 300,000. So I think, those three countries are attractive and interesting right now. We see most demand being for Spain, as things have been a bit uncertain for a number of reasons in Portugal. But they all are quite popular and generating quite a number of inquiries right now.